Last night, the most important question in the market got a verdict, and the answer split the whole trade in two. Micron reported, and it was a blowout. The stock jumped almost 14% after hours on records across the board. The artificial intelligence build is earning its return. That part is now proven. And yet, on the very same tape, Bitcoin fell to a 21-month low near $58,000 and broke its 200-week moving average for only the second time in its entire history. A record print on one side, a capitulation low on the other. That contradiction is the whole story. Start with the verdict because the numbers are staggering. Micron printed a record $41.5 billion of revenue versus $35.5 billion expected, a record gross margin of nearly 85%, earnings of $25.11 a share, a $4.62 beat. Data center revenue up more than sevenfold, $100 billion of contracted revenue already booked, and a guide for next quarter of $50 billion. The artificial intelligence build is not a promise anymore. It is an audited, accelerating fact. So if the build is real, where's the edge? You separate the cash flow from the multiple. Because a record didn't stop the regime, a hawkish Federal Reserve and a rising dollar still pushed crypto, gold, and the leverage complex lower on the same day. The discipline is to own the durable margin, not the headline, not the commodity at a cycle high, not the leveraged proxy, the proprietary data compounder that already prints cash. The crowd traded the headline. The discipline reads the curve. This is the asymmetric. Issue 27, the verdict. Tech and crypto investing for thoughtful retail from an operator's lens. Last issue ended on a dated test, Micron reports, and we find out whether the artificial intelligence build is actually earning its return. This issue is the answer. It came back emphatic, but the verdict didn't change the regime. It sharpened the split between the cash flows and the multiples. Here's the one-line read. The dated test resolved, and it was a blowout. After the close, Micron posted record revenue of $41.5 billion against $35.5 billion expected, a record gross margin of nearly 85%, earnings of $25.11 a share, a $4.62 beat. Data center revenue up more than sevenfold to $11.5 billion. $100 billion of contracted revenue across 16 customer deals, and a $50 billion guide for next quarter. The stock rose almost 14% after hours. The artificial intelligence fundamentals are real, audited, and accelerating, but the verdict did not change the regime. On the same tape, Bitcoin fell to a 21-month low and broke its 200-week moving average for only the second time ever. Gold sat below $4,000 for a sixth straight day. SpaceX completed a $600 billion unwind. A hawkish wash Federal Reserve keeps pressing the leverage layer, so the verdict sharpened the split. Cash flows confirmed, valuations and leverage still derating. Separate the cash flow from the multiple. You'll see the same labels throughout. Confidence, high, medium, or low. Consensus versus variant, what the market believes and where we may differ. And on every call, what would change our mind. That's the discipline. Part 1, the macro regime, the verdict lands, and the regime holds. The 30-second frame. 1. Micron answered emphatically, record revenue, a near 85% margin, data center revenue up more than sevenfold, $100 billion in contracted revenue, a $50 billion guide, and up almost 14% after hours. 2. The regime did not flinch. Bitcoin fell to a 21-month low and broke its 200-week line. Gold sat below $4,000 for a sixth day. The broad market closed roughly flat, with the Nasdaq the only thing holding the tape. 3. The Federal Reserve stayed hawkish. Bank of America calls for 3 more hikes this year. 4. The offset is oil. Brent erased its entire wartime premium as the Strait of Hormuz reopens. And 5. The split is now explicit. Cash flows confirmed. Valuations and leverage still derating. The market is repricing the discount rate, not the demand. Start with the verdict. For its fiscal third quarter, Micron reported a record $41.46 billion of revenue versus about $35.5 billion expected and $23.9 billion the quarter before. That's a $5.8 billion beat on the top line. Gross margin hit a record 84.9%, up from 75% the quarter before and 39% a year ago. Earnings were $25.11 a share, a $4.62 beat. Data center revenue rose more than sevenfold to $11.5 billion, and the company disclosed about $100 billion of minimum contracted revenue across 16 customer agreements, guiding next quarter to $50 billion at roughly an 86% margin. The stock rose almost 14% after hours. Last issue framed this exact print as the gut check. The answer was unambiguous. The build is earning its return, and the curve is still steepening. And yet the regime did not lift. Even on Micron's blowout, Bitcoin fell to a 21-month low near $58,000 and broke its 200-week moving average for only the second time in its history. The last time was the collapse in 2022. Ether traded near multi-year lows. Gold sat below $4,000 for a sixth straight session, near $39.70. The broad market closed roughly flat, with the semiconductor complex the only thing holding the index up. Here is the tell. A record artificial intelligence print did not stop crypto and gold from re-rating, because the force pressing them is not whether the build is real, it is the discount rate. A hawkish Federal Reserve and a rising dollar raise the opportunity cost of every non-yielding and leveraged asset at once. But note the character. This is the shallowest post-peak drawdown in Bitcoin's history. An outflow and macro event, not a systemic break. Over 60% of supply hasn't moved in a year. What keeps pressing the leverage layer? A hawkish Federal Reserve and the squeeze on anything that borrows. Bank of America forecasts 3 more hikes this year. Into inflation it calls unambiguously worse. The new chair's debut projections lean hawkish. One prediction market flagged inflation at a 3-year high. The squeezed layer showed it plainly. SpaceX lost more than $600 billion over 3 sessions. After announcing a roughly $20 billion inaugural bond offering to fund its artificial intelligence ambitions, and the deleveraging bled into the rest of big tech. The same regime that rewards the self-funding cash machine punishes the entity issuing debt into a tightening market. There is a real offset, though. Brent crude erased its entire wartime premium near $73 as the Strait of Hormuz reopens. Morgan Stanley takes the other side of the Federal Reserve call that the oil collapse cuts the inflation impulse and the Fed stays on hold. The crux is the Fed fighting yesterday's inflation. Core inflation data this week is the referee. Part 2, in focus, where durable artificial intelligence margins actually live. Micron just proved the build earns its return, but it did so at the commodity layer, where a record margin is exactly the signal that capacity is coming. So the natural follow-up is, where are the margins durable rather than cyclical? One answer is proprietary data software that compounds regardless of the chip cycle. That's Zeta Global. Its revenue has grown for a 7th straight year, from $729 million in 2023 to just over $1 billion in 2024 to $1.3 billion in 2025, up almost 30%. And critically, it's cash generative and increasingly so. Net cash from operations was $199 million last year, up from $134 million the year before. The reported loss narrowed to just $32 million, and that loss is fully explained by $178 million of non-cash stock compensation. Strip the equity comp, and the underlying business throws off real cash. All of this pulled live from the filings. Now the mechanism, where the durable margin comes from. Micron's print raises a question it cannot answer. Which margin survives the cycle? Zeta's answer has 3 parts. First, the moat is a large pool of opt-in first-party identity data, not third-party cookies. More data improves targeting, which wins customers, which deepens the data. A compounding loop, not a commodity. Second, the growth is accelerating. Not cyclical. Revenue guidance for this year is $1.78 to $1.79 billion, 36 to 37% growth, off 30% last year, while operating cash flow rises. That's the opposite of a memory cycle that mean reverts when capacity arrives. Third, it trades at roughly 3 times sales, a cyclical software multiple for a software growth compounder turning profitable. With an artificial intelligence agent monetizing the data without a commodity pricing race. Micron is the sold-out commodity input. Zeta is the proprietary data compounder. The durable margin lives a layer up. The debate, the bull in the numbers, a cash-generative software compounder at the application layer of artificial intelligence, priced like an ordinary mid-cap at about 3 times sales. Revenue is accelerating while operating cash flow rises to $199 million, and the reported loss collapses to a rounding error against non-cash comp. The proprietary data set is a moat that deepens with scale. The market is paying a cyclical software multiple for software growth economics turning profitable. This is where the margin is durable. The bear, and it's real. Stock compensation, while declining, was still $178 million last year, more than 5 times the reported loss. So shareholders fund growth through ongoing dilution, and the profit rests on adjusted metrics. The company was also the target of a short seller report in 2024 questioning its data sourcing, an unresolved overhang, and its revenue is tied to marketing budgets, which are cyclical. The stock compensation trajectory and the reported line are the referee. The read, a research view, not a call. Zeta is a credible answer to the question Micron's print raises, where artificial intelligence margins are durable rather than cyclical. The filings make the case concrete: 7 straight years of revenue growth to $1.3 billion, operating cash flow up to $199 million, a reported loss smaller than its non-cash compensation, and an accelerating, profitable guide for this year. It is the proprietary data software compounder, not the sold-out commodity, but it carries the risks no application layer name escapes: dilution, a data sourcing overhang, and sensitivity to the ad cycle. What would change the read? Continued cash flow growth, with compensation falling as a share of revenue and the reported line turning genuinely positive. The bull, re-rate towards software peers versus a guide cut, a re-emergence of the data question. Or compensation re-accelerating, the bear, the multiple is cheap for a reason. The countercurrent, because Micron's record is also the capacity signal. A gross margin of nearly 85%, guided even higher, is a record. And records this high have always invited capacity. SK Hynix is reportedly filing a $29 billion listing to add memory supply. Overbuilding is exactly how memory cycles turn. Micron is up roughly 700% over 12 months, priced for the upcycle to persist. That $100 billion in contracted revenue softens it, but contracted volume is not contracted price through a down cycle. So Micron is the right name to own the demand proof, and the wrong name to assume the margin is permanent. Hold the cash machine for what it is, a confirmed, audited demand read, without mistaking an 85% commodity margin for a software annuity. That's why the lead is Zeta, and the countercurrent is Micron's own multiple. And the thematic, the verdict separated artificial intelligence cash flows from artificial intelligence valuations. On a single session, a record fundamentals print coexisted with a 21-month crypto low, a sub-$4,000 gold print, and a $600 billion space X unwind. The market is no longer trading artificial intelligence as one thing. It is repricing the discount rate, which punishes valuations and leverage, while rewarding confirmed cash flow. So reward the self-funding or durable margin layer, the sold-out input that prints cash now, the cash-generative hyperscaler, the toll booth that already prints, and the proprietary data compounder whose margin doesn't depend on a commodity cycle. Be wary of the borrow-to-build and the reflexive lever, the debt-funded build issuing into a tightening market. And the crypto treasury proxy, a verdict day does not unify the trade, it splits it. Part 3, the verdict, separate the cash flow from the multiple. What we are watching over the next 10 days. Core inflation this week. It validates or breaks the hawkish 3 hikes call, and the oil collapse argues for a cooler read. Micron follow-through. Does the print broaden the semiconductors or fade as a one-name event? Bitcoin's 200-week line near 59,000. Reclaim it, and it's a bottoming attempt. Lose it decisively, and the next zone is 48 to 52,000. Washes communication. SpaceX bond pricing. Demand tells you if the deleveraging is over. Gold's hold near 4,000. The Strait of Hormuz normalization. Whether strategy heeds the call to halt coin buys. Zeta's stock compensation trajectory. And whether small-cap breadth survives a hawkish tape. And we keep score in public. Zeta enters as the lead durable margin, proprietary data compounder, own the cash-generative application layer, respect the dilution. Micron, confirmed demand, respect the cycle. The artificial intelligence verdict, cash flows confirmed, valuations and leverage derating. Bitcoin, a capitulation low on a liquidity tape. Gold, constructive structurally, pressed near term. Alphabet, the self-funding compounder. SpaceX, the borrow-to-build squeezed layer. Strategy, avoid the reflexive lever. Nvidia, the self-funding toll booth. And the Federal Reserve path, a hawkish engine against an oil-led disinflation variant. Dated, falsifiable calls, and we grade them. So where does it land? The dated test resolved, and it was a blowout. Micron printed records across the board, and the stock rose almost 14%. The build's returns are real, audited, and accelerating, but the verdict did not change the regime. It sharpened the split. On the same session, Bitcoin broke its 200-week line, gold stayed below $4,000, and SpaceX completed a $600 billion unwind, all pressed by a hawkish Federal Reserve repricing the discount rate. The discipline is to separate the cash flow from the multiple. Micron proved the demand and exposed the question it cannot answer: where do durable margins live once the commodity cycle turns? The candidate is the proprietary data compounder that already generates cash. The crowd traded the headline. The discipline reads the curve. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.